Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. On April 18th and 19th, Fidelity Investments Canada hosted Focus 2024, a two-day event for advisors featuring insights from Fidelity's portfolio managers and subject matter experts. Portfolio manager David Way's session from Focus is today's podcast. Dave was originally hired in 2008 as a research analyst. Then in 2020, now as a portfolio manager, his Fidelity Long Short Alternative Fund was launched. Today, Dave sits down with host Pat Bolland to explain how he is finding the winners and capitalizing on potential losers in this fund that seeks to capture alternative sources of alpha. This podcast was recorded on April 18th, 2024. And also, today's podcast is brought to you by the 2024 Fidelity Retirement Report. For the past 19 years, we have delivered the Fidelity Retirement Report to provide insights and perspectives that can help you feel better prepared for your retirement, whatever that may look like. This year's report explores how the rising cost of living is factoring into Canadians' retirement plans and preparedness. Canadians are still positive about retirement, despite the current economic challenges. Considering these challenges, those with a written retirement plan and those who work with a financial advisor to build their savings are more likely to feel prepared. Head to go.fidelity.ca/retirement to receive the report and insights on how you can better prepare for retirement.
Okay, what people don't know is that you guys actually pick your music.
We do.
What was that?
Beverly Hills Cop, one of the great movies. Very important to me because it was I think the first R-rated movie I got to see when I think it came out in 1987. I might have been 8 years old. But it's really a story about a person who will not take no for an answer, who will overcome whatever stumbling blocks he needs to overcome to help his friend and win friends along the way. So I'm not going to break into any warehouses to try to find alpha, but it's an inspirational story.
Okay, let's talk about this long, short, alternative fund. Kind of a boring name. Why do we call it something like positive alternatives?
Yeah, and I think I didn't get to choose. I would have named it something hard to identify, but maybe interesting. But I think it's a simple fund with a simple name. So what is it? It's a long, short fund. And what we're trying to do is we're trying to access alternative sources of returns that provide differentiation against a long-only fund. Yes, it leverages my skill, but I think positive alternatives would really reflect a couple of things. One is my attitude. I'm mostly positive that at any given time we can find opportunities to make money in the market, and I get to do it in an alternative way. I get to own companies that I'm excited about and short ones where I'm of the view that they're going to disappoint investor expectations.
Okay, how is it structured? Is it a 130-30 fund, or how do you work that out?
So from a mandate perspective, I can be as much as 150% long and 50% short. The goal of the fund over time is probably to run more in the 130-30 range. But at various points in time, you want to be able to take risk that is commensurate with return. So there are points in time where I might be more optimistic about a pocket of stocks and less optimistic about the market overall. And in those cases, I can actually bring my net exposure down. But at its roots, it's a very simple fund structure. I have a long portfolio of 50 to 60 stocks, call it an average position size of 2.5%, and a much more diversified short portfolio of 30 to 40 stocks. And the goal is to try to make money on both sides of that fund. But the most important thing is that when I build these two portfolios, I bring them together in an aggregate portfolio that provides an attractive return profile as well as lower volatility.
So the focus is on return for investors then? That's what you're trying to accomplish?
I think the real key to a successful fund strategy, and I believe this because this is kind of how my brain is wired, I don't know how to think about it in a different way, is that in order to have really good long-term returns in client portfolios, you need to deliver both. There needs to be a reason to invest in this fund versus your other multitudinous investment options. And the way I think you get people to A, trust you, and B, commit to sticking with you through good periods and more challenging periods in the market is to deliver consistent returns with lower volatility. Because when you do that, the 1, 2, and 3 and 4 year numbers stack up into a longer term track record. And I would like as much of that to make its way into client portfolios as possible.
Okay. Walk me through the process then, starting with, I guess, the long side. How do you go about selecting your long positions?
My investment philosophy is what I would describe as flexible. At any given time, you'll see growth stocks, value stocks in my portfolio. Some investors really focus on companies, growing faster than Y% or trading below X times book value or X times earnings. And I can find a way to get excited about kind of companies at both ends of the spectrum. So style is not a portfolio construction tool that I use very frequently at a portfolio level. And the way I look for stocks is that I consider myself macro aware, like what's going on in the macro environment is really important to understanding where expectations of investors lie. And then also really looking at, where are the headwinds and tailwinds in the market? So organizing your hunting process, looking for stocks based on things that you're seeing at a higher level, and then really trying to drive performance along those themes by really focusing on bottom-up stock picking.
Okay, Ramona used that term hunting, which I think is interesting too. But before we came on stage, you talked about a marketing course that you took and how you use it to select positions. Can you explain that for me?
So I have an older brother. He's 3 years older than me. He's also an advisor. But you can imagine like two boys growing up in a household. It was effectively a gladiator ring. We watched a lot of wrestling, and I was often at the receiving end, and my brother trying to find new moves on me. And how that's worked its way into my investment process is that one of the ways that I look at stocks, if I'm looking at a new position, I kind of make it fight against stocks that are already in the fund. And I make stocks within the portfolio kind of compete against each other to see what the absolute best sort of risk reward I can put together at a stock level. And I was telling Pat when I was at Wharton, I was first telling him I'm not very good at marketing because we were talking about something else. And I did say that my favorite professor at Wharton was this marketing professor. And he was the person who innovated on what was called paired choice theory, where it's effectively you can take 20 consumer products, ask consumers to rank 3 of them at a time, and over a series of questions, you actually get a really effective rating of like 1 to 20. And it was really relevant to me because I think that's a really interesting way to look at portfolio construction, because your position sizing, which stocks are in and out, if you look at all stocks kind of at an individual level, you don't always end up with the optimal portfolio. And so it's part of my process to look at things in that way.
One of the winners, if you will, that you've had in your portfolio over time, an example of a long position, has been Dollarama. Why did it win?
I covered Dollarama as a consumer analyst from, I guess, 2012 to 2015. And when you cover a stock at Fidelity, it's your job to know more about that business than anybody else, perhaps other than management. So I've been inside every part of that business. I know what makes the management team tick. And most importantly, I know how changes in the world lead to changes in earnings, because ultimately having a differentiated outlook on earnings is what matters. And a couple of years ago, when inflation was really starting to peak up, Dollarama was one of the companies that was viewed to be very vulnerable to inflation. They're value-based. They were at risk of people believing that their earnings were going to be really pressured. And I actually had the different opinion, which was that the way this business works is that when they contract to buy something, let's say half their stuff comes from China, the moment they agree to make that purchase, they already know what their margins are going to be. Like, you can't go into Dollarama and see something that's 50% off. Like, the price is the price. And so I believe that they had room actually to protect their margins. And I think the stock was call it $50. And it just seemed to me that there was a real dislocation in how people understood a company that was believed to be very well understood and appreciated by the market. And it was something that, when you make stocks fight each other, like this thing kept going to the top. And so I think it became like a 6% position. At its peak, I think it was over 7. And then you fast forward a couple of years, my view of the world turned out to be more correct, stocks up a lot. And I think as of the last disclosure, you would have seen it as a much smaller position. But it's the best retail box in the world in terms of sales productivity, efficiency of the SG&A. Like nobody walks into a Dollarama and say, wow, this store is really nice. But we all go in because you know that whatever price you pay, it's going to be 25% cheaper than what you can get anywhere else. And so that's a really special thing. And if that business existed in the US, because I do have a North American focus, what you would see is intense competition as people tried to copy that model. And Dollar Tree, which is an American company, 10 years ago, they said they were going to go from 100 stores to 1,000 stores. And I actually think the best thing that happened to Dollarama is that Dollar Tree bought Family Dollar. It was a disastrous acquisition, and they've been distracted in the US ever since. So it's a beautiful monopoly, and its value and position sizing in the fund tends to be a function of where I see the company's great fundamentals versus where expectations are.
I've been surprised at their pricing traction too, because it's no longer $1 when you go in; it's $4.50.
Yeah,
you still buy it.
Yeah, it's a great way to add value. And one of the things I learned from the old CEO, Larry, the founder, was that they're continually quite nervous about moving the price points up, because as you move up in price points, you start to bump up against Walmart. But the ability to introduce new price points and offer really attractive value is like hugely powerful to the business. Because if you think of just like a store and there's a peg and there's like Crayola markers at $2 and they sell 10 units, when they take the price point up, they're typically adding 2 more markers to the mix. So they're adding a little bit more value, raising the price, and they're still selling the same amount of units. So it's a really powerful business model. And what you go in there looking for is value, not a specific product.
Yeah. Okay, that's the long side and good example. Let's go through the short side. Walk me through your process there. Is it significantly different?
It can be different. Sometimes in a long security, you can have a view of how the fundamentals will play out and believe that over time the market will appreciate what you appreciate about the business. The short side, I think there's a really important difference. And I've thought about this in different ways, but I read something yesterday that I actually I'm like, this is exactly it. One of the third-party short selling advisors I use wrote sort of like a 2-page memo on how they see the shorting market today. And one of the things they said is like, our fundamental belief is that for a short thesis to work, you need a psychological catalyst. As humans, we are so vulnerable to confirmation bias, like looking for information that confirms what we think about the world. You need something to happen that causes that to break. And so for me, my investment process really integrates this, because I'm looking at sort of 3 different buckets. I'm looking for things that are like classic financial shorts. So a company where I'm negative on their business prospects, either due to a new competitive product or I have concerns about their accounting. And really what you need for those shorts to work is you need some kind of catalyst. And typically that could be a revenue miss or an accounting restatement. But a lot of times what you need is you just need something to happen that causes people to see the world the way that you see it. So situational analysis around when to short a company is really important, because it gets you into short positions at the right time. And it also keeps you out of shorting stocks where you know you're right, but the market's just not going to care for like a year.
Do you have screening processes or buckets that your shorts fall into?
So the first bucket is like classic financial shorts, and there's 2 other buckets that I think are relevant. One is what I call ESG detractors, and there's 2 buckets within that. There's companies that there's something going on in their business model that I think is negative from like an ESG perspective. And this isn't about applying like ESG standards to companies and only buying high-rated stocks. What I'm looking for is a change in the business that will happen that negatively impacts earnings and will cause the stock to go down fundamentally. And I think one of the really unique things about social media, because regulators are often a key catalyst for this, but with social media, you now have a place where like isolated consumer voices can now coalesce into a very powerful movement and cause companies to change.
Yeah.
And so the second part of the ESG detractors, I covered mining during the last big boom, like 2009 to 2011. And one of the things I noticed that like when the copper price went up, all of a sudden all these copper projects came out of the woodwork, and you would meet with these people and they'd have like they'd have a PowerPoint presentation about how they're going to build this mine, and all they needed was, a little $1 billion from you to build it. But they might have had like 2 mining engineers on the project. In some cases, they were lying about some of the work they'd done on the project. And they were really there just to capitalize on investor enthusiasm for copper. And they kind of had no intention of giving you the money. They were going to pay it to themselves. And so within ESG, it's a powerful long-term theme. And so what you do see are companies with, really not very good business models, no product, no innovation, no engineering talent, no patents, who were kind of going out there raising a lot of money, where I felt they would, not be able to deliver against investor enthusiasm for the theme.
Okay, so that's the ESG detractors. Yep. You mentioned financials as well?
Yeah, so like classic financial shorts, like the revenue misses, accounting stuff. And then the third bucket is sort of like, I think something that really helps with the overall volatility of the fund, which I just call like a hedge for long. So it could be a situation where you are really excited about a company, and as we're portfolio managers, but we're really stock analysts first. You find a risk that you just can't hedge away. So what you can do in a long short fund is you can actually short a stock that's exposed to the same risk, take the long position in the company you're excited about, and then it's like an insurance policy. If the risk doesn't play out, your long goes up more than your short goes up, so you make money on the spread and you make absolute dollars.
Oh, more like a paired trade.
Like a pair trade, yeah. So that's a very small part of the fund, but it's effectively, you're playing for a relative value, and it just allows you to like reach deeper into the opportunity. Like if there's this risk, you might only be able to, if you're a long-only manager, be like, I'll take a 2% position. But in my case, I'll be like, maybe I'll take a 4% position. So the fund can benefit from more of the positive analysis you see, while actually mitigating the risk even more than you could with a smaller position.
You kind of glossed over the financial, the accounting issues.
Yep.
Give me an example of a financial malfeasance, if you will, and you shorted and you moved into that area.
Yeah, so I really like accounting. It's a fun topic.
You're alone, I think, in that area.
Yeah. No, we have a dedicated short selling research team at Fidelity. So we have a half dozen people who spend 100% of their time shorting stocks. And one of the things they're really helpful with is they'll run accounting screens. And we have a lot, but one of the examples would be like, here's a company that is showing revenue growth, but all the revenues are going into receivables instead of cash. And that's bad, because that's where companies can manipulate revenues. And so there was a company that I was short called Ebix, an Indian payments company. And this was a feature of the business where revenues were growing, accounts receivables were growing, and cash was like negative. And when I work with this short selling analyst, you dig into it, you realize that the key thing going on is that the business has set up a subsidiary in Mauritius, which is not known for its high standards of investor protection and safety. And there's all this money going to Mauritius to a subsidiary, and IOUs coming back. And that was a huge red flag for us. And we did the work on the company, shorted the stock, and then ultimately it was actually, they tried to take a piece of the business public in India because they had a debt maturity coming due that they just couldn't pay, because as I said, there's no cash flow. And the Indian regulator actually found that they had been overstating their revenues by 95% in that part of the business, which is a lot.
Even by my books.
Yeah. You don't need a calculator for that.
Okay, so then Against all that background, how do you work with macro? What do you think of the market environment right now? Or is that part of are you just stocks?
I think you have to be macro aware. And I was actually in the kind of higher for longer camp. Like we have an amazing GAA team. And what I took away from their conversations was that the path from high inflation to moderate inflation would be navigable. But the path from kind of where we are now to lower inflation would be tougher. And so against that backdrop, you basically want to be more greedy when that's priced in. So you can see like October 2022, October 2023, the outlook wasn't that great, but you can find opportunities to be optimistic when companies are pricing in recession. And so you can actually dig into stocks where bad news is priced in. And then when things get more positive, people get more optimistic about, maybe rates no longer going up to going flat to going down, or where we are today, where maybe investors are concerned about rates, maybe aren't going down, maybe they're actually going up. You can invest against kind of what's priced into stocks, because you can find reasons to get excited no matter what's going on. And obviously the macro analysis will tell you how easy or hard it will be for any individual stock to work. But it's our job as stock analysts to just find companies that can beat earnings. Like in the end, if you keep it simple, stocks that enjoy positive earnings revisions tend to do well over time. And if you can find companies that can do that in a macro environment where maybe it's kind of not really what's priced into the stock, you can still find upside.
Folks, I'll remind you, get your questions into the app. We can get them into Dave. I'll continue, of course. Everybody talks right now about the narrow leadership, the Magnificent Seven, all that kind of jazz. Andrew talked about earnings and momentum. And yet at the same time, Ramona talked about dispersion being very narrow in the marketplace.
Yep.
Is it harder to find long shorts in that environment?
On the long side, I would say no. It's our job as investors to see what opportunities are in front of you now and invest where you have conviction. And if you look at the narrow leadership, Meta was a $100 stock and left for dead because everybody thought Mark Zuckerberg was going to light cash on fire forever to build the metaverse. And things really changed when Facebook came out and said, we're going to be a serious business and we're going to show the earnings power of the business. So it's not just like these stocks are going up because of speculation and themes. There's been really massive positive earnings revisions for that company. And so it was a $100 stock that prospectively could have earnings in the mid-20s if you believe consensus. It's not a Fidelity opinion, it's a consensus opinion. And so when you have these opportunities, I don't care if they're $300 billion companies or $3 billion companies, you invest behind powerful earnings stories at attractive valuations. And so I like more dispersion in the market, because the second part of this question is about the short book. That's been a more challenging place, to be quite honest, to find really great idiosyncratic stories. There's been some increased correlations in the short portfolio. And so my response to that as a portfolio manager is to really invest where I have conviction. And sometimes that means I'll have a short book that's larger, like I've had called 30, 35% of the fund short, and periods where the fund is less short. I think as of the last disclosure, it was in the low teens. But the thing is, challenging periods give way to attractive periods. And so we've seen a lot, some of these stocks that are on sort of my watch list of things that I could be interested in, some of them are up 5 to 8 times what they were a year and a half ago. And for some of these companies, the fundamentals have changed. And for some of the companies, they haven't. So my starting point entering a short in the current environment, might give me a much better margin of safety than it would have given me 18 months ago.
Where do you draw the line? Where do you say, okay, the short didn't work? How did you manage the short? You manage it differently.
I draw the line in pencil, first of all. I have an eraser. There's always information in what the market is telling you. And so I think it's a really good opportunity to listen to the market. And so if you enter a short, the first thing you're trying to do is enter it well. And during 2021, when all these speculative stocks were, going up like crazy, they go from a point where they're interesting longs to, geez, like this is like really overshot, to, okay, now I think we can short it. So you're looking for points of evidence that when you enter the trade that you're like, okay, my view of the world is what will get reflected in stocks. Because if people are trading stocks for reasons other than why I think it's a short, like I kind of need the world to change before the short will work. And so I'm really attuned to the sort of the investor psychology around an individual stock. And a lot of times I'll enter the position in sort of like a governed way where I don't know if I've exactly got it right, but I'm willing to be a little bit early to make sure I capture the inflection point. And so when I'm in that stage of building the position, I may not be surprised if a short goes against me 15% first. It's a small position, you don't see it in the fund, and no investor can pick the top and bottom like all the time.
Right.
And other times when I'm short a stock and a news item comes out that I think is really negative, the stock should be down, and the stock doesn't go down, that's when I really redouble my efforts to be like, okay, did I miss something? Did I retest it? I think the superpower you can have as an investor is to have, really high conviction, but a willingness to change your mind. And so you always have to be open to what can change your mind. And sometimes you stick with the short and you hope that the world sees it your way. And sometimes something's changed where the catalyst you were expecting is played out, the market didn't react to it, or there's new information, and then you move on. Like it's actually something I tell the analysts, like sometimes you get stocks a little bit wrong and your temptation is to try to make the money back on the stock you've lost money on. And the real answer is you should try to make money tomorrow in the most effective, easiest way possible. And that might be another short. It might be a different stock.
What kind of turnover, or on the long side, what kind of duration, how long do you hold things typically?
I think different things happen within the portfolio, but I think on average, the long portfolio inherently should turn over about 50% a year, probably like an average 2-year hold period. And on the short side, you need a much fresher well. Typically, I'm holding shorts for less than a year. I have shorts I've held longer, but you're looking for more immediate catalysts because you're trying to line up an investment opportunity with some identifiable catalysts, and as they play out, you hope or expect to be right. And waiting a long time sort of creates more distance between your decision and being proven right or wrong. And within that time, management as a short seller is always trying to work against you to try to capture value, fix things, promote their idea to the world if they don't have a business and there's nothing to fix. And so it's really incumbent on short sellers to, try to identify a shorter catalyst to profit.
Yeah, you're the enemy in that case. Okay, you mentioned you use a third party for your shorts. How do you work within Fidelity and the Fidelity research team then?
We have really great resources internally. So if you think about the internal resources, like I'd point to 3. There's other PMs that short within the complex, in addition to the ones in Canada. There are other global portfolio managers who short, and we have constant dialogue with that team and the short selling analyst team that I mentioned. And we have long analysts, fundamental analysts at Fidelity who, 15 years ago, it was really like stocks are in 2 buckets. What are stocks we should own versus which ones do we not need to own? But even through that regime, and I think we've shown clients the analyst scissor chart a million times, we have sell-rated securities that over very long duration have underperformed the market. So that is a well of alpha from our global sector analyst team that I can use to generate short ideas. And then the third piece on the stock recommendation side is there is a handful of short selling research firms. You wouldn't know them. They're not on Twitter saying we're short this company, CEO's going to jail, and then they cover the short that day when the stock goes down 7%. These are serious people looking at like companies that are investable, and they do detailed research. And for me, what I'm always looking for is, can we get overlap? Can the sector analyst identify some of these like top-down themes or even a bottom-up thesis that's a sell on the stock? Can our short selling analysts identify other features of a high quality short that makes our odds of success higher? And then do we have an external validation? And because they're small, like the recommendations usually aren't priced into the stocks. It's an outside view on the market. So when you can get all those things aligned and it's an investment opportunity that fits with my process, then I can get really excited.
Long side, you mentioned earlier that you saw great opportunities in the marketplace right now. Are there themes that you're detecting?
Yeah, I think there's, change is the only constant. And as investors, you really look for change. And I think for me, the way that I kind of have the world organized in my head right now is the first bucket is like changing world order. Sounds ominous, but there's an opportunity. And really within that, there's obviously the geopolitical tensions in a number of regions of the world. And what I see the biggest kind of thing that could change is American retrenchment from global affairs, which will change how the world's organized a little. Nearshoring would fit within that. COVID taught a lot of companies that their supply chains are too long. And what's beautiful about this is that this will change too. So their supply chains got long to save money, and then COVID happened and they couldn't deliver their products. And now there's like government incentives and other things leading people to shorten their supply chains. And perhaps in 15 years, I'll be up on stage talking about, well, now there's this new globalization theme. I know we've been talking about nearshoring for 15 years. So this will change, but there's a lot of investment behind this. Really interesting companies that can benefit from just kind of moving factories closer to their end markets. Software-led future, this impacts everything. AI would fit into this theme. EVs would fit into this theme. Like our cars are going to become smartphones over the next 10 years in really big ways. And it's important to know who wins and loses from that. Companies that did things that software can do are in trouble. Like their business model was predicated on using a lot of people to do a task that perhaps an AI solution can deliver, within 2 to 3 years. So in AI, the winners and losers are easy to identify who's winning right now, who will lose. And I think the really interesting thing over the next 2 to 3 years is who can actually develop the products to monetize this technology. And so that's a theme. Like we talked about macro, like we're in a new normal for rates. And there were a lot of business models and companies that kind of built their economic model on high leverage and lower returns. And hurdle rates for everybody are going up because rates are up. And so in a more normal environment, there's some companies that are just on the wrong side of that. And it's really hard for them to get from where they are now to the other side without giving up some of their current economic value as well as their economic potential.
David, thank you so much. David Way.
Thank you for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. Thanks again. See you tomorrow. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments